Everyone ready? We're good? All right. Good afternoon. We have the pleasure of the graveyard shift. Hopefully everyone will stay awake. My name is Joe Mate. I'm an investment director with British International Investment, the UK's development finance institution and impact investor. I have the pleasure of moderating today's panel discussion entitled Private Credit in Africa, the Case For and Against. Before our esteemed panel introduces themselves, perhaps worth noting the work that BII has done in this space. Our private credit fund strategy looks to address a market dislocation in Africa caused by low credit formation. We recognize the opportunity to support an emerging cohort of specialist debt fund managers, and we also recognize the opportunity to mobilize commercial capital for scale. And so we're very excited to hear some of the insights that will be shared by our panel of experts. I'll hand over to the team to introduce themselves, starting with Om to my extreme.
Hi everyone, good afternoon. Om Thacker, I work with TLG Capital. We're a London-based investment manager that focuses on private credit and have been since 2008. We're recently opening offices in Lagos and Tunisia, and we invest primarily US dollars into SMEs in Africa.
Hi everyone, my name is Erika Nel. I'm the head of private debt at Sanlam Investments. Sanlam Investments headquartered in South Africa, but we actually have a footprint across 43 African countries. So in private debt, we at this point in time only operate in South Africa in common monetary areas, and with the intention to just invest in small and medium enterprises with an impact theme. So we are really looking to create jobs, reduce inequality, all of those SDGs that I'm sure you're very familiar with. And we've been doing it for the last 10 years. That's me.
Afternoon, everyone. My name is Abdurrahman Abrams. I'm with the Old Mutual Group, Old Mutual Alternative Investments. Also from South Africa, I am the co-head of the hybrid equity team, which operates within the alternative investments business for Old Mutual. We launched our Fund 1 at the 1st of January in 2021, and before that looked after the same type of investments in the mezzanine and hybrid equity space for about 15 or 16 years, with on-balance sheet for Old Mutual in that time. And today I'm kind of looking to talk about the case for investing by commercial investors into private credit. Thanks.
Great, I'm Saad Sheikh. I run a private credit team at Encore Capital, which is an Africa-focused asset manager operating for a number of years on the continent. They manage several strategies: hedge fund, private equity, and private credit. So we see Africa from a wider lens and looking to chat more about what we're seeing, at least on the private credit side, especially on the impact space.
Thanks. My name is Kenny Nwosu. I'm the CEO of Norset Capital. Been involved in the private equity and credit space over 20 years, but for Norset Capital, company has been involved in the credit space for over 30 years. And principally, we used to invest in Southern Africa, expanded that to the rest of Sub-Saharan Africa, done over $500 million in more than 150 companies in the region. And we're trying to tell a story that you can still invest for impact and still get, attractive returns at the same time, that they do coexist in Africa.
Thank you all. It's perhaps useful to frame today's discussion within the context of a working definition for private credit. Private credit, the term, typically has applied to direct lending with closed-ended funds that look to support mid-sized corporates. But of course, I think the strict definition is much more broad. It includes permanent capital vehicles such as NORSAD, open-ended strategies that look to support trade finance, and it also includes, in some instances, DFI funding as well as distressed debt. Kenny, if I could turn to you, could you give us a sense of the opportunity or the need for credit across Africa?
Thanks, Joe. Interestingly enough, this is an Invest in Africa conference. So most people who are sitting here are involved in Africa. Either you're investing or raising capital in one way or another. And I am not the person to tell you that how difficult it is, the need for it, and nothing probably is more difficult than that. But that being said, it is the case we continuously have to make. And I think just to put it in context, we have a population in Africa of what, 1.3, 1.4 billion. We have a GDP of $3 trillion US, and that's if you take GDP as the measurement, that captures the size of our economies. We have large informal economies, so some would say that our economies are actually much larger in that context. That being said, I think the World Bank said that the credit gap is about $360 billion US, with over 20 million businesses lacking access to finance. That's a lot of businesses. And those that do have the access, are they getting the right structure to enable growth? Or do you have to use working capital facilities for long-term growth? That again poses the constraints that some of the businesses have to face. You can also extrapolate that and look at infrastructure. I think typically it has been estimated that you do have a gap of 100 to $140 billion annually, with only available capital of about 50 billion. That again also shows that gap. Or we can look at it in context of, I think Riskura had something that about a third of unlisted capital coming into sub-Saharan Africa comes as credit, versus 2/3 in more developed markets. This begin to show the gap. Or the World Bank, I think, saying in terms of credit formation to GDP, being less than 40% in Africa, compared to almost 150% in more developed nations. So less than 40% of GDP, and I said that GDP might be underestimated when you take into account the size of our informal sector. So many of you have more stats to go to show the need for that. And then when we put it again in a practical sense, we do have a banking-related institutions who also, because of when they finance, tight restrictions, etc., it makes sense for a lot of them to fund our governments because it's lower risk, it's high yield. So where is the funding going to develop the businesses that are going to propel our growth? But this just to give context. I'm sure you have more data points, and so does Joe, to really make the case for the financing. So it is clear, but sometimes it's good to put it in that context so that we understand that there is a great need for the funding on our continent.
Thanks, Kenny. That really brings it to light. Erica, if I could turn to you, given the working definition that we have, given this funding gap that Kenny's really unpacked, what's the opportunity for institutional investors in this space? And I'm keen to particularly, look at your experience in the South African market and some of the developments for institutions looking at private capital market and private debt.
Oh, thanks, Joe. I think over the last 10 years, we have seen an increase in the need for institutional investors to get more active in this market and invest more. From where we started having conversations with institutions, they really, number one, saw private debt in the same bucket as private equity. So firstly, you needed to educate the investors first on the differences. And then there was these inherent risks that are seen in private credit, small businesses not being able to fund or repay funding, not having enough capital or enough experience, so there was these perceptions that we had to change as well. But I can say COVID had possibly only one benefit for our market, was that institutional investors saw the need to help and support small businesses, not just during COVID, but also after COVID and recovery post-COVID. And that is really, in South Africa, we've seen quite a lot of increased support from institutional investors for that initiatives. We've seen a lot of large pension funds coming to the party, giving funding specifically for SMEs. And also, I think the colleagues just before this session referred to the fact that you don't have to give up financial return to do good.
Yeah.
So we're seeing pension funds and institutional investors, realizing that you can have impact and help job creation and all of the other SDGs, but still earn a decent financial return. So I would say there's a lot of opportunity. It's brilliant stats that Kenny just, I don't have to repeat any of that. That is the opportunity. And I think institutional investors are seeing it more and more.
Thanks, Erica. One of the challenges the continent faces, obviously, is the perceived risk of doing business versus the real risk. And I think it's fair to say that the African narrative doesn't capture a lot of the points that actually make Africa a compelling place to do business. Stats such as the ones that obviously Kenny's touched on, but I think there's a lot of opportunity in a lot of themes across Africa that make Africa an interesting place to do business. If I could turn to you, you spend a lot of time with some of your client base and investors bridging that gap. Could you talk us through your experience to walking them through the real risk versus the perceived risk? And also importantly, I think as we develop the asset class in Africa, keen to understand what can be learned from more developed markets, such as Europe, and how Europe developed post the GFC in 2008.
Thanks, Joe. I think, some of it's not entirely explainable, is part of the answer. There's a paper by a couple of academics in the University of Michigan that say, for African sovereign issuers, there's a 2.9% premium that's not explained by fundamentals that regularly issuers at the sovereign level have to bear. So we can already sort of start by saying this isn't something that we're going to solve or find out why, but for some reason there's a premium that's risk, that's not explained by illiquidity, that's not explained by reserve ratios, it's not explained by anything rational that exists in the African credit markets. And these are public markets, so you can imagine what private spreads look like. I think, maybe to answer your question in parts, one thing that gets a bad rep are central banks and banks, which I think are, especially on the continent, pretty exceptional institutions. You're seeing right now Basel III is being rolled out in Nigeria, when it was done in Europe sort of nearly a decade ago. And the main issue is not that banks aren't fulfilling their regulatory obligations. The main issue isn't even that banks aren't profitable, that they don't hire smart people. It's primarily market access. At the moment, the long end of the curve has Ghana trading at 35 cents in the dollar. Nigeria, January 2023 risk can make you 10% in dollars if you buy the bonds today. And so when you're adding premium on top of that for banks, for private credit, for liquidity, whatever it is, it's incredibly difficult to get to a stage where the entrepreneur's happy, investors who have this risk perception in their mind are happy, and also a credit fund is able to source these deals and regularly return capital back through distributions, through liquidity, whatever it is. And so if we take the banks as an example, I think Axis Bank was quite fortunate that they raised additional Tier 1 last year. Yeah. This year I don't see, definitely no bank in Ghana is going to be able to raise public additional Tier 1. In Nigeria it's going to be incredibly tricky. And so I think beyond just perceived risk, this risk is validated by the people who are running the books and the people that are filling the books. And I don't think there's enough out there to sort of provide a contrary view to that opinion. Part of the answer is somewhat in what Erica said in terms of coming up with institutional investors. We spent a lot of time in Lagos last month because we're working with the pension fund administrators there. There are 14 trillion naira of pension fund assets in Nigeria. 70% of this sits in T-bills. And so when official inflation in Nigeria is 20%, and everyone knows it's way higher than that because the cost of diesel has 5x'd in the last 12 months, and T-bills are returning 12% because the central bank has put a cash reserve ratio of 37% that everyone knows is actually 60%, so they're mopping up liquidity from depositors to keep the cost of government borrowing low, which, by the way, is not an Africa problem. It's what Japan's been doing for 5 years. It's what the Fed's doing now when you see the premium at SOFR, because now repos are occurring in the private markets, not public markets. It was what the Bank of England should have done if Bank of England and the Chancellor of the UK was maybe a bit more competent. But this is not an Africa problem. This is monetary systems full stop. And I think when you're you've got that going on at the same time that there's zero market access in the public markets, It's incredibly difficult to get investors to step into private credit if institutionally allocators aren't doing it themselves. 14 trillion naira in assets, 75% in T-bills, 0.3% in private equity. Alternatives themselves by local investors should be 5%. If it's standing at 1 or 2, why are you going to take your dollar assets and not buy Nigeria 3-year risk at 15%? And so I think that's part of the challenge. I don't know if there's anything else you sort of, I mean, in terms of how we've bridged that, I think you start with a lot of relative value. So especially in the tech space, what we found a lot of joy is finding a lot of businesses that have strong receivables. So in the entertainment space, now Amazon and Netflix are coming to the party. You can discount their receivables in Delaware. The same with ag tech startups that can sell to Carrefour and large European grocery stores. At least you have a cost of capital build-up that makes sense because there are more efficient credit markets that can price it accordingly. But if you're just starting with sort of illiquid Africa SME that's doing a great job, has an 18% EBITDA margin, grows revenue 30% year on year, but the sovereign's trading at double digits in dollars, it becomes incredibly difficult to go to your investors and justify why you're only charging this company 8% in cash and the rest in warrants.
Okay. I think that's a useful seg to Saad and Abdurrahman. Really keen to hear from your perspective as leaders of teams that are actually deploying capital into these markets and obviously raising institutional capital. What are the conversations that you're having with some of these institutions? What are you positioning to them in terms of what private credit offers, particularly in the current environment, the current market, and some of the themes that everyone has kind of touched on? What kind of sets private credit apart? If I could start with you, Sal.
Fantastic. Joe, thanks a lot. And fantastic kind of comments. I think Om's made a very strong case for against private credit.
Someone has to. Everyone else is private credit here.
I'd really like to figure out, why we're doing private credit now. So the conversation that we're having with investors, firstly, it's about educating them around the perceived risks that you're talking about, which they're associating a significant amount of premium to it. Is that right? No. Africa has always been a stepchild of the continent, which is very unfair. It's developing. The constraints that are being put on the banking sector, if you compare when developed markets that stand today, 50 or 70 years earlier, when they were standing and developing and kind of getting to where they are today, did they have the IFRS 9, 16, Basel III restrictions on them? No, they didn't. Yeah. Right? They kind of were allowed to reign free. But guess what? African banks aren't in that space, and they're reined in. As a consequence, what can they do? They do what you guys have absolutely talked about. They buy 60 to 70% T-bills, the balance of 20 to 30% in corporate, and 5 to 6% in SMEs. Absolutely, that's the case, and that's where the real case for private credit kicks in. There is capital out there that is looking for yield, that is looking for an alternative to equity. Now, the equity story in Africa is a great story. People have really flourished. Enco Capital itself has a private equity fund, and they'll yield a 16% return. So I can't talk against that. But I guess what I have to stipulate here is the need for a downside protected angle where investors feel comfortable. Not protected entirely, because Africa comes with its own jurisdictional hazards around the legal framework, but at least there's a downside layer protecting the space for most of that capital that goes in. So that's the conversation that we have with investors is, if you really are gung-ho about the equity, then you should consider the private debt space, which will give you two advantages. One, you get downside protected, you get liquidity, because it's self-liquidating structures. You don't have to chase after an exit, which may or may not appear. So, hope and prayer is not what we're kind of signing up for in private credit. In addition to that, the last piece is what I feel becomes a real burden on businesses is when the relative value gets kicked in, right? So 16% Kenya T-bills are trading at the moment. Now, if you put that as a benchmark and then put a premium, SMEs can't survive. Yeah. That's 20% on the dollar straight up. No business can survive that. So then you've got to dial that risk back. You've got to say, okay, no, that's not how we can do. There's a dislocation in the public market. Figure that out. That's a liquidity, and that was discussed previously. So without going into detail, that's a liquidity crisis. Now, but kind of looking at the fundamentals of the SMEs and how they're creating jobs, the likes of yourself, DFI communities, really kind of adding that layer below it. And then the institutional capital has got to really kind of develop that strength within themselves to really look beyond the obvious. to kind of going back to what Om is saying, absolutely, that's the obvious. But if you look beyond that, if you see that there is relative value being created, you are going to build on that through warrants, through kickers, through certain other structures, there's significant value to be extrapolated. And as a consequence, what Kenny and Erica said, there's significant value being created not only in terms of money value, but in terms of development. The amount of jobs that are being created, the amount of impact that is created not only on the climate assets, but on other areas such as job creation, lack of poverty, healthcare, economic development. We've got to look beyond that. And there is significant capital in the market to focus on this. And that's, I think, the conversation that we're having.
Thanks, Saad. Abdurrahman?
Sure, I think Saad's basically covered everything.
Stolen your thunder.
Sorry about that. No, but that's fine. I mean, maybe to echo some of the sentiments and add to that from Saad's perspective and my own. This isn't a new asset class, and I think maybe investors need to understand there's lots of credibility that sits behind teams that have been in the market for 20, 30 years already, understand what they're doing, and it's different to kind of a short-term dislocation that Om spoke about. Here you are taking a long-term view. It's a closed-end fund, 10 years out, maybe 15 years out, some permanent capital vehicles. And I think those tend to kind of have longevity, and you need to sell investors that story about the long-term impact that you're investing in. And I think there are a few other, call it more commercial aspects to it, and I think Saad mentioned around downside protection. You build that in over and above what the normal equity investor would have. I mean, our mantra is always around like, first don't lose any money. So your team focuses on that when they go out and think about each investment they make. Thereafter, they kind of layer on what you think of as a kind of hurdle return for your investor. And thereafter, these warrants and other kind of financial features to kind of get that upside and return for investors. So I think that is one aspect that you're selling to investors. The other is liquidity. And all of these businesses, I think I mentioned, you get like genuinely good companies generating EBITDA margins 60, 80%. And they're growing 10, 20% year on year, even more than that. There is cash being generated, and you want your investors to be part of that investment. You want them to be able to access that type of return and do good and have impact in what they do. I think another aspect and more commercial is around exit risk. And if you're in the private credit market, and we focus more on mezzanine debt and hybrid equity, there is a lower amount of exit risk relative to the private equity market. And the reason for that is you either structure investments with regular interest payments or coupons, and you either have a kind of self-liquidating investment, and you're not subject to this kind of massive event risk that happens right at the end of 7 or 10 years. So you then can structure around getting your liquidity over time, and maybe refinance at the end or other alternative exit mechanisms to kind of get your cash back as an investor. So I think all of those, if you're kind of packaging them into a sales pitch for investors and why they should consider private credit, and in our case, hybrid equity or mezzanine debt, I think there's a massive case to be made. It's not a new investment. It's not a new investment class. It has credibility. It has years of experience, teams that have experience to do it. And I think that should be part of the message that you're telling investors. I don't think you should focus on the short term and where there are liquidity constraints in the private credit markets relative to the public market. You should kind of take a step back and see what the genuine impact of the investments are and what they can do for you. So I think that's maybe just to summarize where we stand on this point there, Joe.
No, that's great. I think...
Sure, if I may add.
Of course, please.
And I think whilst we see it from both sides, I think we have to look at both sides of the equation. You know, it's not like it's about equity or debt. It's about growing the pie. You know, we need to be able to look at the structures. We don't think that there's no substitute for equity when you need it, but you also need, even if you look at capital structures, you do need that debt in that capital structure to actually have a bigger pie. I mean, private equity has been going on for a while, but actually when we look at what has been the median returns on the continent versus in terms of private debt, is it always the right structure, even when you need it? most businesses going to raise funding don't always want an equity partner. They also need the right structure. Maybe it's a family business. Maybe the timing is not right to bring in that equity partner. Why are they being diluted early, if need be? But there is, again, I'm putting it in context, there is no substitute for equity. That's the beginning of the capital. To go and start, you start with the equity. But we need to be able to have solutions beyond the one size, equity and go to the bank and whatever they give you, take. We should have structures that work for our businesses to be able to grow. So the way we see private credit, it's complementary financing. It's complementary to bank financing. It's complementary to equity financing. And no one size fits all. What does the business need? And if that business needs equity, it should take more equity. If it needs the right structure to finance, then that should take it into account. I know some of the restrictions will say, but that's why we got to develop the market. It may be difficult to give a dollar facility when the business needs some local currency facility. Maybe that's the discussion also we should be going into. How do we also develop ability to also create that in local currency? But first, you got to get the financing first. I mean, if you're looking, you got to get it first. Then you want to also get it in the currency that matters also for you. But it's got to be available. So it's not one solution at the expense of the other. We need to look at a holistic solution. If not, we will keep the pie constrained. We would keep these businesses constrained, and they feed into each other. We have a corporate sector that has to be supported by so many mid-market and SMEs, and then micro. You're not going to be a solid corporate structure if the rest of the pyramid is weak. So how do we support that rest of the pyramid to grow? So that's why I said it is a holistic solution. So whilst we might be saying case for or against, the case is for more capital. But in terms of, if you look at capital, what is the capacity of a balance sheet? Is the capacity of most balance sheets in growing economies for more equity or for more debt or for more credit? What is the right optimal structure? So, but that's in support of what Sad and Mani have said.
Thanks. I think it's very clear that there's a very strong opinions about the opportunity set for private credit, and in some instances against. At the risk of putting myself on the spot, can I ask each of you to comment on what development finance institutions can do to help develop this asset class? Kenny, I'll start with you. I know this is a favorite topic of yours.
Okay, I'll save some of our private conversations for this public forum. But I think, joking aside, the development financial institutions, the DFIs, have been the backbone of our Africa financial system. I mean, and if we look at, over the last 20 years, development has been, again, underpinned by what the DFIs have done in the sector. But that being said, what can they do? Allocate more. I mean, there are other things that can be done, but more has to be allocated, in terms of financing and to the asset class. Are there other solutions? Yes, there are other solutions. Usually because our DFIs are catalytic, and they've been lending in Africa for 20 plus years. They have data. You see, a lot of the time there's an asymmetry of data, of information that impacts also data. How do you judge? How do you look at risk? DFIs have more data than a lot of, or at least in terms of some outside or private looking to go in. How do we aggregate that so that we can learn and see how do we better bridge what you mentioned about the real and that perceived risk? Because when we do, then they catalyze and bring in further funding. And in addition to that, with the data also being more available, it can also be catalytic in terms of also the secondary market. Because when that comes through, it will then also bridge the gap in terms of what the banks and your other MFIs are able to do. So those are some of the things. And also even look at solutions around currency risk. Again, those are things they can do, but it shouldn't take away from having to allocate more to the asset class.
Deploy. Sad?
And then listen, I agree. What I would like to add is I think DFIs play a phenomenal role on the continent, not only kind of developing an asset class, be it private credit or otherwise, I think they're galvanizing capital. And yes, the argument can be do more or do less. I think one thing that they could potentially do, and I'm not in the space, very easy for me to kind of throw stones at kind of glass houses and whatever the saying goes. But I think a PAC community, right? So what that means is BIR is doing a phenomenal job. What they did a couple of years back, they kind of did a carpet analysis, right? A whole case study of what the African landscape it needs in terms of private credit, and then kind of created a layer above it, a team that kind of does exactly that. Now, BIR is kind of a forerunner, but there are a few laggards. So why don't the laggards just kind of team up, right? So work alongside as a whole pack of DFIs. One of the things that I find quite surprising is you'll go to a DFI with no kind of particular references here, and while they would have done a MES or a credit fund previously, they're very averse to it now. Why? What's changed? The demand's still there. Why kind of the reticence now? So I find that quite interesting, and while they're there to galvanize, they're the layer that will bring or attract the second layer of kind of commercial capital. So why stop now? The capital is there, countries are allocating, governments are allocating, the mandates are there. Why become nervous? If the asset class has underperformed, like private equity, for example, in some cases, as Kenny was saying, the returns aren't great, sure, take a pause, figure out what that means. But when that asset class is new, why take a break in the middle? It's time to accelerate. Let's all go as a pack and build up this asset class. And then fine, we can kind of take a little bit of a pause, see how it's performing. But I think the asset class so far has not done poorly.
Thanks, Sad. Rahman?
Yeah, I think I agree with the first two speakers, and I think to add to that, we're in fundraising mode at the moment, and we're talking to investors. And one class of investor is DFI. And I think there's lots of questions that are asked, and it's difficult to kind of understand each and every mandate that's out there and what the different drivers behind decision making is. But I would kind of urge the guys to consider this fund that we manage, and more generally this asset class as a whole, and deploy more capital, allocate more, and allow it to grow. And I think that catalytic effect is important, because once you allocate and it's successful, it feeds off itself, it supports more fundraising, it supports more investments. And that cycle is virtuous. It's a good thing if they do that. And the impact they can have is significant. So, I mean, we focused in South Africa mainly, but there is the intention to go into Africa. And if you are kind of giving that support to these managers that have been successful in the past, are able to deploy the capital successfully and have a good track record, I think you're going to kind of catalyze that industry and allow more investment across the continent as well.
Thanks. Erica?
No, Joe, I think it's, I cannot add to what my colleagues have said, but I think it is my duty as a female to say, support more female asset managers in this space. We are few and far between. Most of our funds are still small, and we're really trying to do the impactful investments and also pass on as much of our funding to female initiatives and female-owned businesses. So I think female-led investment management teams are scarce. We're really trying hard to raise capital, and the support from the DFIs would be fantastic. And I think also I would just want to add to what Kenny said in this respect as well. Share with us what you think, what you want, and also what data you've collected in the time that you've been in Africa. So I think it's a learning curve for all of us, but we are privileged as females to be working in an industry where we actually can live our passion as well. So if we can get support for that, I think that would be the best solution.
Thank you.
Thanks.
Powerful words.
I think for me, it's possibly two things. Firstly is working with local long-term liabilities. I mean, I think I should reiterate again that it's so important that pension funds and insurers on the continent are allocating to their own alternative asset classes, as well as dollar investors doing so. So capacity building to that extent is really helpful. Even in the tech space, I mean, the number of businesses you see that raise $200 million in venture debt, require local currency, and just buy them as cross-currency swaps from Standard Chartered when they could have raised the money locally. I mean, it's great if you work in fixed sales. It's not great for anyone else. And the second point is probably just helping with capacity building. It's all very well providing leverage to a business, but what we're seeing is that you need strong finance functions, you need strong reporting, you need strong monitoring. You also need shareholders that are willing to step up and carry on providing equity into the business, especially during times of distress. I mean, the number of balance sheets that we've seen where interest potentially accrues, and all of a sudden it becomes a game theory situation where it's like, do we raise our bridge round at a cent a share just to make sure everyone follows on? I think the extent to which DFIs can help build strong reporting and monitoring, cadence, as well as making sure that shareholders in private equity who are having their own moments in Africa right now when it comes to fundraising are also able to step up is crucial.
Thank you.
Can I have a disclosure? So I think as much as I studied the case, I think for disclosure, from a NORSAT perspective, as much as I think, there is always room to do more. I think to say in the case of NORSAT, I think for the 20-something years, it was 100% supported by DFIs.
I was about to say.
Even in the context of our balance sheet, it was 70% DFI supported, and we've brought in all the private sector. But that being said, I think in terms of looking at the scope of what we can do, more can be done. But I think, and that's why I started by prefacing to say that a lot of what we have done and achieved is because of the involvement of DFI. So it's good to put that context there.
Sure.
I got to say thank you to Swedfund as well, because they're here and they're our largest investor. So.
Someone sent Kenny a text. I'm looking into my chair to see if we have time for questions from the audience.
I think we have 9 minutes.
We have 5 minutes. Rui, is that you? Do we have a mic?
Yeah, this one goes for, I'm guessing, for the left side of the panel, most likely. It's on, your thoughts on nascent markets, on, markets that are not really being tapped into investments at this point. Because you have, usually when you think about Africa, there are other places where the usual suspects, you're going to Egypt, Kenya, Morocco, Nigeria. But what about other countries in Central Africa and even in Southern Africa, such as mine, for example, Angola, which is a peculiar place, as I understand. So maybe here's some thoughts from your side as to markets such as my market, which hasn't really been tapped into in terms of DFI investments, in private equity investments. How do you usually make a decision as to, all right, now it's time to starting to invest in these markets?
Is that directed at anyone in particular?
That's actually directed to most of the panel, to be honest.
Can you go for it?
So anyone
Sounds like a Kenny question.
Joe, you can try to answer it.
No, absolutely, far from that. Look, for us, when we look at a transaction, we start by thinking, how does this deal help us build a better Africa? Once we get that looking at impact, then we look at things commercially. So yes, we may have limited exposure to some markets because, just the economics and the environment may be tight. We still get exposure, in terms of we're in the DRC, we're in Mozambique, we're in Zimbabwe. We've done quite a lot in Zimbabwe. So you mentioned in terms of countries, people think, oh no. It does pose also issues for us when we're raising funding. People look at our exposure in some of these markets. But if I tell them that we've done best in Zimbabwe than most other markets, it's difficult. You almost have to prove every single point and show them, and they go back and look at that data. It doesn't make it easier to get in. But, we're of the view that, and we see that across the continent, that great businesses, even in struggling markets, sometimes are better than marginal businesses in good markets. How do we put the right structure? How do we follow them in terms of closely? Look, it does take a little bit of resources to go through, manage, follow up in that regards. But these are areas we keep on working on, getting more data to see how can we invest in some of these transitional economies when we come across. But we do invest there. It doesn't make it any easier. It does take more resources, but it does help, again, around that impact story and overall return. So at least from a context of NORSAD, we do get involved in some of these markets. Maybe not as much as we would like to currently, but we're looking at ways of doing more.
Sure, listen, what I'll add is the way that we look at it is we go kind of top-down, EDFI, kind of the exclusion list, try to figure out what we can and cannot do based on where the capital is being sourced from. So our capital mostly comes from either pension funds, financial institutions, and DFIs even. So we follow kind of to the letter the countries that we're allowed to invest in. So, for example, ex-South Africa is a perfect example. I won't go into Angola right now. But there's certain countries that investors do shy away from. So we, as kind of subsequent representatives of the investors, we have to kind of abide by that. So that's kind of a first layer. And then second layer is about country risk. So the macro analysis that we do from a hedge fund perspective, that entire market strategy that we have, then tells us which particular markets to get into. So that kind of further narrows down the funnel, and then opportunities, as Kenny said, in that country, based on the research that we have, we'll then dig down and kind of really figure out the sector that we want to do. And then sector focus is, again, another funnel that we need to take the opportunity through. So, we can't do, for example, mining. So what do we do if it's a mining deal in Angola? It's completely off the charts, right? So that's something that we would consider when we're investing.
Thanks. Of course.
I mean, we haven't done Angola, but we've done like Togo, Benin, Côte d'Ivoire, Tunisia, and I lived in Mozambique for 2 years. And I think the issue sometimes becomes an enforcement question. In terms of these countries may not have English law, you may need to hire translators. In Mozambique, Tunisia, in Ethiopia, you can't legally own land. And so the question just becomes, in a downside scenario, unless you've got very clear-cut enhancement from a bank that's owned by a South African or Portuguese bank, I mean, a lot of the problem that I see just becomes how do you actually enforce? Because I don't think anyone, unless you have a team in Luanda, like no one's going to fly down to try and seize a rubber factory as collateral.
So how do you actually deal with that? I mean, that's often the question, that jurisdictional risk. How do you think about that from an origination perspective when you're looking at the deal when it starts out? And if you do get into trouble, how do you think about what levers do you pull to try and manage that?
So I think it comes down to structuring and it comes down to enhancement. And what you find is that typically, especially with Basel III coming now, the capital requirements for contingent liabilities are far less than those for liabilities. And that's actually great from a private credit perspective, because what it means is that if you've got a loan, especially if you've got an NPL that's in phase 1 or phase 2, you can release a lot of capital from a cash reserve perspective by issuing a contingent liability against that asset, as opposed to keeping it on your book. And so this works more in stress situations, although sometimes it works where banks don't have term funding. But as a way to originate, I think it all comes down to how you structure. If you can structure it as a BCP in Portugal, has a subsidiary in Angola, they issue a SWIFT message because they need to release, it goes from 100% to 30%. So you free up a lot of capital. You release a standby letter of credit against which you can leverage. It's brilliant. If it's just a share pledge or a factory where someone in Angola signs a letter saying that it's in your name, great, but maybe not.
Thanks all. I think we're out of time. Thank you very much to my esteemed panel. This has been a really enjoyable chat. I've learned a lot, and I hope the audience has too. Thank you.